Well, markets are set to close in the red just a day after reaching 5-year highs following the surprise announcement that the Fed would not start to scale back its bond purchases. Now we're joined by Derek Orth of Brendan Econ. Derek, how would you explain the reaction in markets today? Are they simply digesting the more somber economic outlook from the Fed?
Yeah, I think we're just kind of consolidating the spike we had yesterday from the surprise of the Fed announcement. Right now, the market's down about 37 points. The S&P's down about 2. I see support in the S&P 500 around that 1710 level, which was the August high prior to yesterday's run-up. So if we do have a consolidation from the move we had yesterday, which seems like we are right now, I'm expecting that range to be an area of support for basically testing out the trend that's been in place.
Okay. Now, some of the defensive sectors are off today. Utilities were lower, so are consumer staples. That reaction doesn't seem to be logical if the economy isn't on a sure footing.
Well, yeah, I think what you want to look at here is just when it comes to the Fed's decision about, they're not happy with the employment rate still, so they have that dual mandate. And I think it's another reason. We also have the scare of the debt ceiling coming up too. So the Fed wanted to keep the liquidity program in place, kind of hopefully to keep that going to dampen any of the volatility from that potential pullback in the market due to the debt crisis or the debt ceiling crisis maybe that's coming up. So we're just basically consolidating moves from yesterday. I'm not really, seeing anything technically bad. Obviously, things have been going pretty good. So we'll see what we do next few days going forward here.
Okay, and just finally, how would you characterise valuations at this point? Are they stretched, or is it simply a question of there's no better place to be than equities if rates will eventually rise?
Well, I think you can look at your dividend yields here. You can look at various companies that have announced major buybacks and increasing dividends. That and forward PE ratio. I guess you can look at too. That there's some companies in various sectors that are looking still attractive here. On a long-term basis, following the trend here, the S&P 500 trading at all-time highs, but has a significant area of support underneath. It is well underneath it by a few hundred points, actually around about 1560 is that level. Now that's the old high of 2007 and the dot-com high of around 1560 back in 2000. So we basically surpassed that more or less a decade worth of support. And we back tested it on the first breakout, and we've went and rallied since. And so now I think, going forward here, as the market consolidates this move we had from yesterday, we just got to keep an eye on the trend channel that's been taken in place. And I think various sectors and consumer staples, for an example, the momentum and the growth is basically in the other sectors where you want to kind of capture. And that could be another thing too, where maybe some of the market participants that hadn't been missing this rally for quite some time now are looking to get into other more growth-driven sectors to try to make up for what they've lost by being on the sidelines.
Okay, there you have it. Still plenty of opportunities in the market. That was Derek Orth of Brendan Econ, and I'm Jane Searle for The Deal.